Tilray's Q3 earnings just hit the wire, and you have to see this. The headlines are screaming one thing, but the stock is doing the complete opposite. They're talking record revenue. They're talking a massive, near-total reduction in net loss. Sounds amazing, right? But the stock is down almost 30% this year. The market, to put it bluntly, just isn't buying what they're selling. Now, this is exactly the kind of disconnect we hunt for here at Iron Financial. Our entire mission is to help you forge a stronger, more resilient portfolio by putting the official story, the corporate press release, to the ultimate test. So today, we're dragging Tilray into the forge. We're putting it right on the anvil. And we're about to find out, is this company made of solid steel, or is it about to shatter under the slightest pressure?
Oh, absolutely. I mean, look at this. It's a classic tale of two tapes. You almost can't believe they're talking about the same company. On one side, you've got the company's story, their press release, and they are painting an absolute masterpiece. They're telling you, look at our record revenue. Look at how we've practically eliminated our net loss from last year. It is the story of a perfect turnaround, a company that is firing on all cylinders. But then you look at the other tape, the one the market is actually trading on. And that story, it's a complete mess. The stock is getting hammered this year, and buried in this supposedly great report was a massive earnings per share miss. They missed the target by over 71%. So what is going on here? Who's telling the truth? Is management actually building an impenetrable fortress brick by brick? Or is the market seeing deep structural cracks in the foundation that the company is desperately trying to paper over? That's the real question.
All right, let's get right to it. No time to waste. Here is our drill down for today. First, we are going to peel back the layers and separate the flashy headlines from the hard reality. Then, I'm going to step in and build the bull case. I'm going to lay out the story that management wants you, the investor, to believe. After that, my colleague here is going to do what he does best. He's going to grab a sledgehammer and see if that beautiful structure can actually withstand some pressure. He's going to look for the cracks. We'll then spend some time dissecting their huge, company-defining bet on the beverage industry. And finally, we will bring it all together and deliver our final verdict. Is Tilray a golden opportunity to build on, or is it a dangerous trap waiting to spring?
Okay, so I'll take the floor first. Let's build the bull case, piece by piece. And look, to be fair to Tilray's management, you have to give them credit where it's due. The structure they're trying to build is ambitious, and you don't post headline numbers like these by accident. They are clearly executing a very specific, very deliberate global strategy. On the surface, the numbers look solid, even impressive. This is the foundation that they are presenting to Wall Street, and it deserves a serious look.
The entire bull case begins right here, with the top line. A record $206.7 million in Q3 revenue. And get this, that's up 11% year over year. Now you have to put that in context. In today's market, especially for the cannabis sector where capital is drying up and smaller competitors are literally going bankrupt, double-digit growth is absolutely nothing to sneeze at. This isn't just a number on a page. It's a powerful statement. It's meant to be the cornerstone of their entire bull case. A clear, undeniable sign of a company with a solid plan that is executing, that is taking market share and aggressively expanding its global reach. From a bull's perspective, this is a very, very strong start. And when you dig a little deeper into that top-line number, you see that this isn't some one-trick pony. The growth is coming from multiple diversified engines. You've got the wellness segment up a healthy 16%. Their German pharmaceutical distribution arm is up a very solid 35%. But the real story, the absolute engine driving this entire growth narrative is their international cannabis business. It's up a staggering 73%. 73! This demonstrates a massive competitive advantage. While everyone else is getting bogged down in the saturated, hyper-competitive, and fragmented North American markets, Tilray is successfully planting its flags all across the globe. We're talking about high-margin medical markets in places like Germany, Poland, and Australia. This isn't just about the Canadian market anymore. Tilray is actively building a global empire.
And this quote right here, it perfectly illustrates the story coming from the top. The CEO, Irwin Simon, he says it himself. Our record third-quarter results demonstrate the strength and momentum of our diversified global platform. Now listen to those words carefully. He's not just talking about one good quarter. He's not saying we had a lucky 3 months. He's talking about a platform, a machine, something that's built for sustained momentum. He is telling the market in no uncertain terms that the strategy is working, all the pieces are finally in place, and these record results are the undeniable proof. This is the official story of a company confidently firing on all cylinders.
And then we get to the absolute showstopper, the headline that grabs everyone's attention, a 97% reduction in net loss year over year. Let me repeat that, 97%. They went from a loss of nearly $800 million in this quarter last year to a loss of just $25 million this year.
I mean, that is the number that makes you sit up, lean forward, and really pay attention. The bull case argues that this is hard, undeniable evidence of incredibly disciplined financial management. It suggests they've finally gotten their costs under control and are on a clear and very rapid path to consistent profitability. This isn't just trimming a little fat around the edges. The bulls would argue this represents a fundamental, positive shift in the company's entire financial structure.
So, the final pillar supporting this entire bull case is financial stability, durability. Tilray right now has what you could call a fortress balance sheet. They're sitting on nearly $265 million in cash and securities, and importantly, they have a net cash position of about $3.5 million. That simply means they have more cash on hand than total debt. In this environment, that is huge. It means they have the firepower not just to survive any market turmoil, but to thrive in it. They can fund their global expansion and make strategic acquisitions without having to take on risky, expensive debt. You add to that the $33 million in annualized cost savings they've already achieved, and the bull case looks incredibly compelling. You've got strong, diversified growth, a clear and dramatic path towards profitability, and a rock-solid financial foundation to build on.
Okay, that is a very compelling structure. I'll give you that. It's a beautiful blueprint. It's the kind of thing an architect would be proud to show off. But here's the thing about blueprints. They're just paper. The real question, the only question that matters, is whether that foundation can actually handle any real pressure. So it's time for the stress test. It's my job here to represent the market skepticism, to take a sledgehammer to that pristine foundation and see what, if anything, starts to crack. And trust me when I tell you, the cracks appear almost immediately.
The very first swing of the hammer is the earnings miss, and it's a big one. While everyone was mesmerized by that shiny record revenue number, the professional traders on Wall Street saw this, a loss of 24 cents per share. The problem? The consensus estimate, what everyone was expecting, was a loss of only 14 cents per share. That is a massive negative surprise of more than 71%. This immediately calls that whole flawless execution narrative into question. I mean, how can you stand up and claim you're firing on all cylinders when you miss your bottom line profit target by such a ridiculously wide margin? It strongly suggests that either your costs are spiraling out of control or the profitability of all that new revenue isn't nearly as strong as you want us to believe. This isn't a hairline fracture. This is a major crack, right at the base.
And hey, let's talk about that record revenue for a second. Where is it actually coming from? Because if you bought this stock thinking Tilray is a pure-play cannabis company, you might want to sit down. Cannabis is only 31% of their total revenue. Their biggest single segment, at a whopping 40%, is a low-margin pharmaceutical distribution business in Germany. Now, it's stable, yes, but it's not the high-growth, high-margin cannabis play that so many investors are looking for. It also means that their overall corporate margin profile gets dragged down by this huge, less profitable business. This isn't a simple growth story, folks. It's a complex, sprawling consumer packaged goods company, and as we're about to see, not all of its parts are performing equally.
And that diversification my colleague was so excited about? Well, it's a double-edged sword. Let's look at the year-over-year growth of these different segments. That international cannabis explosion you mentioned, it's absolutely real, and it helped drive the total cannabis revenue up a respectable 19%. The German distribution business grew an impressive 35%. But look over here. Look at the beverage segment. This is supposed to be a key pillar of their entire future growth strategy, their big entry into the US market, and it is down. Not flat, not a little bit down. It is down 24% year over year. That is not a crack. That is a chasm. A company cannot claim to have a flawless, powerful growth platform when one of its core strategic pillars is crumbling at a rate of 24%. This directly contradicts the CEO's narrative of uniform strength and momentum.
All right, now for the main event. Let's circle back to that incredible, unbelievable 97% improvement in net loss. You know, the headline number that the entire bull case is anchored on? The one that suggests this massive, miraculous turnaround in profitability. You have to ask yourself, you have to be skeptical and ask, how is a number that good even possible in 1 year? Is it the result of real, sustainable operational improvements, or is it just a little bit of financial engineering, a trick of the light? Is it a sign of true strength, or is it a very convenient smokescreen?
And here it is. This is the gotcha moment. The truth, as it so often is buried in the footnotes of the financial statements. Last year's massive $793 million loss wasn't an operational loss in the traditional sense. The vast majority of it, nearly $700 million, was a one-time, non-cash goodwill impairment charge. Now, in plain English, that's just a fancy accounting term for when a company has to officially admit, oops, we massively overpaid for an acquisition we made in the past. So if you strip out that one-time accounting charge to get a real apples-to-apples comparison of the business operations, last year's operational loss was actually around $94 million. This year's loss is $25 million. Is that an improvement? Absolutely it is. But it's a 73% improvement from $94 million, not a 97% improvement from a massively inflated $793 million. The 97% figure is technically true, but it's also profoundly misleading. It's built on a foundation of a weak comparison, and that shakes the credibility of the entire report.
Oh, but it gets even more confusing from there. You see, Tilray, like many companies these days, essentially reports two different sets of books. You have the official number, the one that's regulated by the SEC and follows generally accepted accounting principles, or GAAP. By that official measure, they lost $25.2 million, period. But then, they provide their own special adjusted number, and by that metric, they claim they actually made a profit of $2.4 million. That's a nearly $28 million swing between the two versions of reality. So which is it? Are they losing money, or are they making money? Well, it depends on which version of their story you choose to believe. The market is clearly telling you it is skeptical of the adjusted feel-good version.
So what on earth does adjusted mean? Well, it means the company's accounting department gets to play magician, waving a magic wand and making real, actual business expenses disappear. They exclude things like one-time impairments, costs related to restructuring the company, and my personal favorite, stock-based compensation. Now, last I checked, paying your employees and executives with company stock is a very real expense that absolutely impacts shareholder value. The bear case here is simple. These adjusted numbers are a fantasy. They are designed to paint a picture of profitability that just isn't real according to standard accounting rules. It's a way to tell a good story, but it's not necessarily the true story. All right, let's pivot and focus on one of the most critical parts of Tilray's entire long-term strategy, their huge bet on the beverage industry. This is their big play for the massive U.S. market. Since they can't legally touch cannabis directly in the U.S. until federal legalization happens, they're building this giant craft beverage platform to act as a Trojan horse. The idea is to have the infrastructure and brands ready to pounce the second the laws change. It's a very forward-looking, very ambitious plan. But the key question for investors is this. Are they patiently building a sustainable, profitable business, or are they just frantically buying revenue to fill a gaping hole in their growth story?
Now, from a purely strategic standpoint, you can see why the plan looks like a masterstroke. They just recently acquired BrewDog, which is a leading craft beer brand in the UK, for about £40 million, all cash. This isn't just about buying a cool brand, it's about buying established infrastructure, distribution networks, and production facilities. On top of that, they've inked a major partnership with a global giant, Carlsberg, that officially kicks off in 2027. This entire blueprint is designed to build what they call a scaled global beverage platform that gives them an immediate and powerful footprint, not just in the US, but across Europe and the Asia-Pacific region as well. This is the heavy lifting, the long-term strategic construction they believe is needed to become a true global consumer packaged goods powerhouse.
But this is where I have to bring it right back to the numbers. That all sounds fantastic on a PowerPoint slide at a strategy meeting, but we just saw, with our own eyes, that their existing organic beverage business is shrinking by 24% year over year. So they're spending £40 million in cold hard cash to double down on a segment that is already showing significant, alarming weakness. So is this really a brilliant, forward-thinking strategic pivot? Or is it a desperate attempt to buy top-line growth to distract investors from the bleeding that's happening in their current beverage portfolio? It's a really high-stakes bet. They are spending real cash on a plan that the current data strongly suggests is not working. The question you have to ask is whether buying BrewDog actually fixes the underlying problem, or if it just makes the problem £40 million bigger. Okay, that brings us to the final verdict. We've laid out the bull case, this grand, ambitious vision of a global CPG company with a strong foundation and incredible momentum. And we've stress-tested it, and we have revealed some pretty significant cracks and some very questionable numbers. So, after weighing all the evidence from both sides, is Tilray a genuine opportunity to get in on the ground floor of a growing global empire? Or is it a carefully constructed trap for investors who are only reading the headlines?
So, here it is, the final weigh-in, side by side. The foundation, the bull case, rests on that explosive 73% growth in international cannabis. That is real. It rests on a solid net cash balance sheet and a diversified revenue stream. These are legitimate strengths.
But the cracks, the bear case, are just as strong, if not stronger. You have a shocking 24% decline in their key strategic beverage segment. You have a misleading net loss comparison that frankly erodes trust. You have a big earnings miss that calls their execution into question, and you have that gaping chasm between their official GAAP profits and their own adjusted profits. You simply cannot ignore either side of this ledger.
Which leads us to this inescapable conclusion. Tilray is a company of profound and unsettling contradictions. It's like a structure with some pillars that are clearly made of solid steel and others that appear to be made of glass. That international cannabis growth is real, and it is very impressive. But it's paired with a beverage unit that is struggling mightily. They are consistently posting headline numbers that look absolutely fantastic on a press release, but begin to crumble and fall apart the moment you apply even a small amount of critical inspection. The foundation right now is simply not as solid as the blueprint would have you believe.
So here is the final, crucial question we leave with you. There is absolutely no doubt that Tilray is building something big. They have a bold, global ambition. The question you have to answer for your own portfolio is this: are you buying the blueprint? Do you believe in that long-term vision enough to overlook the very real, very current cracks? Can you ignore the shrinking beverage sales and the questionable accounting? Or do you wait on the sidelines? Do you wait to see if the walls they are building today will actually hold under pressure tomorrow? That is the decision you have to make, and that is what we do here at Iron Financial. We give you the tools and the analysis you need to look past the corporate sales pitch and inspect the structural integrity for yourself.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.